Okay. But okay. Hello everyone. Hope you guys have a great Easter holiday. I mean Easter day. And yep. So for right now, just give a few minutes for people to onboarding. So feel free to scan this QR code. This is a collaboration events between the Economic Society at U of H with the Finance Association. Shout out to Toby for help coordinate this event for us. And with that, yes, just give up 1 to 2 minutes before we jump into the session today. So for the first 45 minutes, it's going to be me and Toby teaching the economics fundamental, but then 45 minutes after, going to be very engaging. You have a chance to hear from the Federal Reserve's. He has more than decades of experience working at Federal Reserves and have a chance to ask question at the end. But for now, we'd love to kind of want to see how what you guys gonna do if you landed on the moon. Um, what will be something that you will do uh, if you guys want to look at that? Since we know there's a space program recently that after 50 years that they fly people out to the moon again. So it's interesting to see how's in the next decades what's gonna be about the finance and market economics of space. Yes. That 1 second. Right, maybe just 1 more minute. Here, second. Let me double check the poll here. What you guys got?
Can you see the responses?
Oh yes, I can see the
Oh,
responses. I'll let you guys see it now too. Um Yes, on that note, we have our pleasure to have our head of marketing, Savannah, here. She's just landed an internship uh, with, she just landed an internship. And so feel free to reach out to her for coffee chat and insights. Once again, congratulations, Savannah. All right, I'm gonna end the poll. You guys want to see? So there's majorities are like I guess commodities trader. Um but interesting. All right. And that's it for some of the fun. And now let's kick it start, guys. So once again, thank you so much for the Econ Society and Toby with along with me here gonna run the sessions today about economics. The agenda right now we'll touch over the market news update and then go into the technical workshop 45 minutes and then 45 minutes of talking with the Federal Reserves. And with that, Toby, you can help us kickstart the new sections and I leave it to you.
Yeah, thank you. So for this week, we are looking at the recent newsletter for what we have this week. So basically, we see that metals company has jumped up by 7% after new mining milestones, and there's different major indexes that rallied last week after multiple weeks of continued losses. And if we could go to the next page. This for this page, this is the news from the recent statistics on the Bureau of Labor Statistics. So the U.S. market has showed stronger than expected job growth in March, with non-farm payrolls increasing by 178,000 jobs. And this marks a huge rebound from previous month's decline and has exceeded expectations, which signals short-term resilience. And I also mentioned that the unemployment rate has decreased a bit at fell to 4.3% due to a mostly on a drop in the labor force participation, meaning there's more people dropping out of the labor force. Um, and we also see, and specifically, there's different job gains like in healthcare, construction, and transportation. And we also see that wage growth has remained very steadily, have remained slightly steadily, but only like a 2.2% increase, with only a modest monthly increase and its slowest annual growth since 2021. So personally, I think this is important because it shows kind of a disconnect between strong headline data and weaker underlying fundamentals. And to me, this reinforces the idea that the Fed will likely have to remain patient when it comes to dealing with interest rates and see how this labor market will be stabilizing rather than jumping in and solving this kind of issue of not only of the dropping labor force participation, but just to see how long would this surplus of job creation could go.
Yes.
So
Uh, I would love to add one more thing. So you guys on the lookout for U.S. non-farm payrolls. So remember that term, and then also remember about the labor force participation and then unemployment rate here. So those are pop. You're gonna see that on the news a lot. I'm gonna touch it later on in the session, but
yeah,
pass it back to Toby.
yeah, thank you. So moving on to the next slide, this or next page, this is based on what is going on in the Middle East right now. And we've seen that the ongoing conflict has been escalated with the Strait of Hormuz effectively disrupted around 20% of the global oil supply. And also that Iran's control over the straits and its decision to charge passage fees has added even more further pressure to global trade. And the conflict has already pushed the Brent crude price up 40%, which could be contributing to inflationary pressures worldwide. And at the same time, equity markets have been weakening, which highlights a slight fear of stagflation, which is an economic concept that we'll go over in further detail later on. And and markets are closely watching it on today's deadline, which is April 6th, and future developments as of outcomes will significantly impact energy prices. So I think this is one of the most significant macro risks right now because this single geopolitical choke point is it's influencing heavily on global inflation and growth. And in my view, this situation very shows how fragile the global supply chains are and why the energy markets really are the key drivers of how macroeconomic trends are visually taken to place.
All
And
right.
that is it. Anything else you want to add on that, Win?
Oh no, you touched it on perfectly. Thank you, Toby.
Yeah, thank
And
you.
Reed, would love to we're glad to have you here and help us updating on this part.
Yeah, of course. So this is Diego's part. He did a piece about Palantir. And for those of you unfamiliar, they basically use AI to syndicate large sources of data and act as like a proprietary like AI insider that can turn that data into different things and look through it all. I guess one of the problems companies have now is they can't just trust random open models. They have to get it secured so it doesn't leak data. And that's one of the things Palantir does, and they also turn it into projects and much more. They work a lot with defense contractors right now. And so they've been dropped a lot recently. Part of it is because a lot of their growth is a bit speculative. They haven't yet reached it. They recently had a really good earnings report where they grew like 40% year over year, which is massive. But the question is whether it's going to be able to continue that into perpetuity. So when things like the Iran war happen and your interest rates are rising, and there's a bit of skepticism about how the AI data center demand will be able to handle the growth and the grid restrictions, so that premium that it's trading at just drops quite a bit. It's actually one of the poster childs right now for those super high PE valuations, which is basically just price to earnings, like that stock price relative to how much they're actually making. So they have a lot, and even when it's adjusted, which is the forward, it's still over 100 times. And usually the sweet spot there where it gets high is like 30. So let's just give you a reference of how much higher they're trading. And yeah, any questions on that one?
Nope.
No.
Thank you, Reed. That's perfect.
And then yeah, SpaceX. So this has been a pretty big year for IPOs, which is when publics go public for the first time. You'll probably hear of some names like Claude and Anthropic, OpenAI, and SpaceX is actually going to be the biggest, we believe, so far, coming in at $2 trillion valuation. That's going to put them right up there with all the Mag 7 leaders. And they'll probably be sort of the black sheep of that one, similar to how Palantir, they'll have a really high valuation because they only make about 15 billion in revenue, which is way lower than you would expect to see a company be top five, top 10 most valuable companies in the world. But sort of like Palantir, it's all about that future prospects. When you have something dealing with rockets and space, people just believe the sky's the limit for this company. You know, they are the go-to rocket contractor for the government right now, and they're the leader in aerospace engineering for all that. So when things like Artemis and all this back to the moon stuff is happening, people think they're going to get a lot more contracts and revenue. But as it stands right now, most of their money is coming from the Starlink, and that is the satellite Wi-Fi subscription that's launched recently. On top of that, they're also an AI company. They combined with Elon's XAI company, so they do a lot of things. And yeah, I'm going to hand it off to Roberto to actually talk about that Artemis mission.
Maybe one thing,
Yes.
just one quick thing want to add on to Reed part is very insightful. So for those who just doing the commercial banking, this is 21 banks helping to finance this deal. So this is like banking 101, right? No one bank want to take on the whole debt, but then this case they want to chop them up to kind of diversify the risk across different banks. But yeah, what kind of want to
Yeah,
see.
currently, yeah, I was gonna say, as it stands, this is going to be the largest IPO in history. Just to
Yeah.
give you a reference. People are
Um,
thinking OpenAI could compete, but yeah, just to give you guys an idea.
maybe in the future there will be some specialized banker who, underwrite loans for space company. Well, that's interesting. All right, pass it on to Roberto.
Yes. Thank you so much, Gwen and Reed, for this week's newsletter. So we're basically looking at the something massive that just happened. I'm currently with them right now. It's a joke. So outside the usual market news, it was the launch of Artemis 2. If you guys get to look like SpaceX stocks, there have been a good turnover after this launch. So for the first time in over 50 years, humans have officially left the Earth orbit, which is amazing to me actually. And now they're heading back to the moon. And right now there's a crew of like four astronauts, and they're on a historic 10-day road trip flying around the moon, which is great, it's beautiful, and it's kind of more to test out like brand new spacecraft tech. From a business and a finance perspective, as we all hopefully to see it, there's the scale is unbelievable. The overall space program, it's sitting for around a massive of $90 billion. And only this launch, it was around for $4 million. But that money it's paving the way for the future. They're setting right now the stage for the future missions to actually mine frozen moon ice. I was reading a little bit about that, and I found that actually fascinating, and how to kind of turn it into a rocket fuel. I don't know how true that is. I'm not a rocket science guy. I don't really. So we'll definitely we'll checking this out, and
Mhm.
which is it's a huge stepping stone that we need to eventually get humans to Mars, which is gonna be a great way. And another super interesting that I read this week, it was that they had a chance to do this gravity big menu that they had, and they included a lot of barbecue brisket, like five types of hot sauces, and a bunch of tortillas, which I found really uh funny and fascinated. But yeah, I'll encourage you guys to read more about that. Thank you.
Interesting. So,
Yeah,
interesting
same.
there, Roberto. I think so this is kind of like a practice run. They
Mhm.
just said that, hey, let's do a try run of like running around the moon and see how it is. And it's just a breeze. And like Roberto said, we still have like 86 billion left for this program, which means, they try to build out stuff on the moon and potentially in the future. So the future of space, the future of like who knows, space lending, like lending
Right.
money to space companies to do all this exploration. Maybe that's a thing. But yeah, other than that, let's also help us update on once again. Thank you so much, Roberto, Reed, Toby for help
Of course.
updating this portion. Let's update on the event we have this week um with FA. So on Wednesday we will have a public speaking workshop. Definitely coming out so you guys, boost your confidence when you networking, when you be there in front of recruiters. Yes, you have the technical skills, but at the end, what get us a job is the connection. So right now, at this time, you guys are in the 6 sessions already. So your technical, I say it is there already. It's just now you move to the next step would be to get the connections and this workshop would help. ExxonMobil, another event focused on AI workshop, help you guys understand what is going on in the market right now, how AI is leveraged. I actually don't know anything, and that's why I don't know anything about AI just yet. So that I didn't incorporate any sessions into AI. But in the future, after this session, next semester, hopefully there's some AI workshop.
We also
Yes.
note that the ExxonMobil is RSVP only, so make sure that you RSVP in the group chat before spots run out because they're running out quick.
Thank you so much, Savannah, for the heads up. All right, and then lastly would be on Friday. This is a Houston CRE and Finance Symposium. This is a chance for you to come out there to network, put your knowledge and getting the network. If in the summer and you don't doing any network, you are setting yourself back a lot. So I say this is one of those events where you come in out and you immediately have people to schedule a call in the summer, right? All right, and then with that, let's jump right into the workshop today. All right. Well, that's not supposed to be like that, but all right. So economics. What is economics? So basically, this is a definition, right? The study of choices under scarcity. And to me, when I first studied economics, I didn't know what is scarcity, but it means that there is limited resources, right? You cannot choose everything you want. The fact that you sitting here and listen to me and the teams, that is your choice. You could have chosen to play games, you could have chosen to do other activities, but then you choose. So you forego your other opportunities to play games and other part, right? Then why does it matter in finance? To know about economics, right? Um, Economics help you understand the interest rate. You heard on the news a lot, the Federal Reserve, Jerome Powell, he increased interest rate, he do interest rate cut. So those are all economics concept. It impact your stock, your bond, your valuations of everything. Because interest rate affect all these, right? And then I will talk about that later on. But then here's a real world hook. So let's say you want to understand economics because you asked the question. Let's say, why do stock fall when inflation rises, right? And if your head was like, all right, when inflation rises, which means, well, because I have experience already, right? When inflation rises, the Federal Reserve usually increase interest rate to make inflation falling down. However, as interest rate rises, it make borrowing costs go up. So that companies are harder to borrowing. That's why stock go down when inflation rises. Well, to the untrained or not, well, because that is, I have 2-3 years of experience talking about these concepts. That's why I come up with that pretty quick, right? But then if you are not sure yet, that is why economics and understanding of these fundamentals is so important. Next up, let's talking about the opportunities cost. So once again, there's always a trade-off. If you choose to sit here, then you forego your chance to do other things. All right, let's give you guys a quick example here. On the left, that is me, and then on the right, that's Toby. Let's say I could produce only one thing at a time. I could produce one banana, or I could produce one fish. And then for Toby, the case is different. He can produce one banana at a time, or he can produce 3 fish at a time. So the question is, should both produce banana, right? And the answer is no. The reason, if you are looking for the best trade, the best alternative, let's say for Toby here, for one banana, instead of producing one banana, he could producing 3 fish. So let's say if he produced that banana, that means he losing 3 fish, right? So that is the opportunity cost for Toby. The concept of opportunity cost is the, well, based on the Federal Reserve guest speaker, is the hardest concept. So in this case, for Toby, he would love to produce fish. He don't want to produce any banana. And then after he producing fish, he could trade 2 fish for a banana. All right, and that concept is it's a trade, right? So you guys know that we have trade between US, China. You know, China have dominant in certain trade, and US has some dominant in certain trade, such as aircraft, high-tech technology, right? So this concept is applicable to country. And definitely when we make a trade, you know, it's not going to be as clear as this: one banana for 2 fish. You know, countries could negotiate. All right, I think you can only get 1.5 a fish. Well, just some perspective for you guys. All right, and then next up is the law of demand and law of supply. For now, just focus on the word law of demand and law of supply. I will explain later on. So the infamous graph. You guys probably, if you study, you know, high school classes, you guys see the graph like this. Don't panic just yet. I'm going to review super quick. So let's first talking about the law of the demand. The reason why the graph, the line, the slope going down for the demand curve is because, so on the y-axis here, you see is the price. And then on the x-axis is the quantity. So the higher the price, the less quantity you can buy. So let's say for buyer, if you decreasing the price, you want to buy more. So that's why the graph going down, right? Because if you go to the right here, that's more quantity. And so if you lowering the price, you get to the people want more quantity. So if, for example, for oil here, if the oil price lower, you know, we want to buy more. Well, but actually that's not the case. We'll explain why. But for Apple, that is the case. So let's say if the price of Apple now is like, was it iPhone 16 now? I don't recall, but the newest iPhone, let's say if it dropped like 50%, would you want to buy a lot of iPhone? Yes, right? So that's to explain. All right, now is the second curve, which is the law of supply, which in this way is going up. So one note to keep in mind is that for the law of demand, this is buyer, but for law of supply, this is supplier, right? This is a seller. For the seller, the more money it could charge per product, then they want to produce more, right? It just makes sense, right? Let's say I want a lot of that product, then it only makes sense for the producer that, all right, if you want that much of quantity, hey, pay me whatever the price, I will produce whatever the unit you like to be. So that's why on the supply side it's going up. All right. And then here's the most, well, this one can be very confusing because once you overlap those two together, sometimes you can be confusing, but just remember the line going down is the buyer, and then the line going up is the seller. All right, let's first indicate a scenario where a price is very high. Let's say if the price set is very high up here, then what's happened? If we're looking at the supply curve right here, we see that at this very high price, yes, they would charge the high price, but then they can produce more. But then on the demand side, which is the buyer side, with this high price, the buyer only want less. They don't want to buy more at that price, right? You only have one iPhone. You didn't have two. I mean, maybe you have, but you don't have 5 iPhone, I suppose, right? But if let's say the price is this low, well, I'll talk about that case once later on. But if you have the gap, like this is called surplus, but well, that's for economic shake. But let's talking about how about if price is super low. You see for the buyer, if the price is super low, yes, you want this much of iPhone. You want like 10 iPhone if like the price for per iPhone is $50. Yeah, I want like 1,000 iPhone, right? But then for the supplier, there's no incentive for them to create a lot of products because at that low price, they don't have that incentive to create a lot of products, right? Well, and that cause shortage, and that's for the sake of economics. But here is the interesting part. In the economy, there is always something called an equilibrium. It is when the supply side and the buyer side agree on one price, right? Which is fair market price, right? That is when you see the two curve kind of interact. Okay, but that's for now. Well, maybe one last thing I want to share is that, well, I'll show it later. Okay. All right. For this part, for the sake of explanations, I will move a curve around. So one thing to keep in mind is that supply and demand change all the time, right? Let's say for oil. Right now, you see that the demand for oil is, well, let's say the demand for oil is constant. But then for the supply of demand with the Strait in Hormuz, and you guys go out to the pump too, you see, because the shortage of the oil, that's why the supply change. That's why the supply curve change. And that is interesting. Why? Because and that also show why the graph here is very powerful. Is let's say this is before the war happened, but then after the war happened, the supply decreased, right? Well, the concept when it's decreased, the graph moved to the left, which means it move up like this. The reason is because at every single unit, it's cost much more, right? But for now, let's keep it simple. Let's just say it's going up. And then now what do you see? Now what we see is that the price over here is higher than the price that we got over here, right? And that's explained why now with the war in Hormuz that we have higher price for oil. And this graph is changing all the time, right? If let's say tomorrow the demand of oil decrease, then the price, well, demand of oil decrease, then the fair market value change. Let's say the supply change, then the price change. Let's say the supply chain this way, the market price change, which is the equilibrium, the middle point right here. Why is it important for finance students to know this? Well, the usefulness of economic is that you could put these into something that you could explain, right? Instead of just saying, all right, when supply decrease, price it going up, right? What if sometimes you wrong about it, right? That's why these are the tools to help you articulate what you means more correctly. All right, and then I'm going next. All right, here's a short description of when you know like to shift things, right? To shift the supply up and down or the demand up and down, right? So it just mean, let's say just for the demand curve side. It's move when there's is income rises, like people making richer so they could spend more. Population increase, that's why they need more of that product. If population increase and you probably more people want Apple. A few things. But this list is very powerful because if you are a finance student, and these are maybe some of the things that you have to consider to analyze that your particular products. Let's say you have to see, is that area population, is it increased? If it decreased, probably the demand for that product gonna shrink, right? You could ask all sorts of questions to understand more how your business make money. What's the demand? And also supply, right? You see, let's say the government, there's a trade war, going right now, then that affects the supply. These are all sorts of questions you could ask to understand whether your supply is going this or that, right? All right, I'm gonna go over to the next concept is elasticity. Just real quick, elasticity is this measure how sensitive one variable is to another variable. Well, it's kind of confusing, but let's do this exercise. Do you still pay for gasoline regardless of the price? Right? Like even if $100 now, you probably still have to do. And that is this, what I will explain on the next graph. But the next question I ask is, do you still pay for Chick-fil-A regardless of the price? Like if Chick-fil-A going up from the meal size to $100 now, would you buy it? No, right? No. The answer is no. All right. And then that's explain the concept of inelasticity and elasticity. This case, we just talk about demand, but if you guys can explore the supply side, but it's pretty applicable to both. So demand, you remember, is a downslope here. Let's say for oil, right? You say even the price change, even if the price like overblown, let's say going up to here, right, which is very high, there is only a few changes in quantity, but you still need a lot of quantity still, right? But then for Chick-fil-A, right here, let's say you increase the price to very high right here, and you see suddenly you lost all the people that want Chick-fil-A. And so that's the concept. So which one is what do I say? For inelasticity, it is talking about the products that is less sensitive to change in price, right? Well, it's still kind of confusing talking about it, but as you practice, you kind of know. And this is pretty interesting. Why? Because let's say you are a financial analyst and you are working in oil and gas. Then you know oil and gas is inelastic, which means like regardless of how pricing go up or down, there still be a lot of demand, right? But however, for Chick-fil-A, if you are the analyst working in that industry, you would know that, all right, if Chick-fil-A pricing, man, that's tough because other competitors, they are alternative for you go Wednesday, you go McDonald's, right? And so it's just something to keep in mind. This is like understanding the fundamental of the industry that you do finance for. All right, I'm just gonna go real quick over this for those who are interesting. But the way you find the total revenue is that the equilibrium right here, which is in the middle. If you go down, if you find the area out of it, right here you see the gasoline, and let's say this is Chick-fil-A. They have the same revenue at this point. Well, don't worry so much, but just bear with me. And let's say the supply change, right? Let's say price going up. So what different here is only the red line that it's move up, right? The red line, it didn't move up. The blue line stay the same. You will see the green box right here for gasoline. That is as the price going up, gasoline is making more revenue. The green box right here is more than the blue box for gasoline. However, for Chick-fil-A, the revenue is shrinking if pricing going up, which is interesting. Well, that's why study about economics is pretty cool. All right, next up, let's talk about GDP. As you know, GDP is standing for gross domestic product. It's measure all these parts. So all these addition, if it's come together, it's equal GDP. So first is consumer spending. You know, you spending on that coffee, you spending on that laptop, iPhone. That's going to this area. Government expenditure, right? These are investment into infrastructure, building schools, creating jobs that related to those area, right? Like even spending on these like moon trip is also considered government spending, right? And then public-private investment. This is just say your company invest more in equipment that's going to GDP, and then lastly would be the net export. So it just export minus how much you import, and that's how you get GDP. Next up is talking about economic cycle. So as you might know, there is the expansion, there's a recessions. Right now people are talking we might walk into a recession or stagflations. To give you guys the best scenario of why economic cycle happen, right? Why do we have like a peak and why do we all suddenly like drop, right? Let's talk about AI. Right now, the US, they just want to get a head start with AI. They don't really care like if it's like overinvestment. And that is why we can be overinvest. But then when we don't make that return, that's why the economy drop, right? Because you overinvest. That's the price you pay. But however, there's a concept of short run and long run. Right here, you could see in the red area, you are terrible, right? As let's say US is terrible in red area. But in the long run, if you take the average, if the long run is still good, well, that is for economists, that is still a good sign because economic cycle is bound to happen. All right, we only have a few minutes left. Let's breeze through these pretty quickly. So this is the most important important stuff for today, which is this three circle right here: interest rate, inflation, unemployment. You hear all over the news. One thing to point out is inflation and unemployment is called by the market. So let's say the more stuff you buy, it's good called inflation. Let's say company firing people, that's called unemployment. But to help making these two scenarios less severe, that's when the Fed affect the interest rate to kind of impact inflation and impact unemployment. But just keep in mind these two are kind of like a market cause, and then interest rate is what the Federal Reserve can do to help the market. All right. Once again, inflation. Let's talk about inflation super quick. There's two types of inflation. The first one is a cost push, right? Cost push, which means right now oil price, you see there's a limited resources of oil that makes oil price going up. In this case, you see the price from this equilibrium going up to this equilibrium, higher price, which call inflations, whichever every time that it's have a higher price, it's inflations. Right here, you see is called a demand push. So before is supply push, but this one is called demand push. Demand push is simple. Let's say a lot of people wanting Apple, like all of a sudden, it's bound to make that product inflate in price, right? A few ways for you to look at inflation on the news. They're gonna use a lot of CPI, Consumer Price Index. PCE is similar to CPI, but it add a few more things to it. But this PCE is what the Federal Reserve used to target the 2% inflation, like long-term growth. Right now, it's I believe it's above 2%. Not knowing what exactly, but I think around 3%, right? So it's above 2.9, 3%. So it's above the target. So CPI, PCE is what Fed base it on. And then lastly would be PPI, Producer Price Index. A cool thing about this is CPI is measure the end user. Let's say the end user, you go to Walmart and you buy product, that is going to CPI. But then for producer, it is when the producer import that product, what is the price of that product? Why do I say it's interesting? Sometimes company, they absorb prices. That's why you don't yet see the inflation going down to the people, because they absorbing prices. They don't try to raise their price to beat inflation yet. So CPI can be lagging, right? Because company can try to absorb a lot of prices, but then at some point when inflation is too bad, that's when you're gonna see in CPI. It's flow from PPI to CPI. Well, that's something to keep in mind. All right, let's talk about a special scenario. We have recession and stagflation. Once again, recession is when, okay, let's put it this way. So the differentiator, both have GDP falling and unemployment rising, right? So right now you guys see unemployment is still not too bad, right? GDP is not too bad. So we are not in there yet. Recession, we are not in stagflation yet. But the key difference is that for recession, inflation is low. For stagflation, inflation is high. Right now, we see that inflation is high, right? And so that is why people are worried that that we might have into stagflation instead of recessions. So keep it simple. Stagflation is just like recession, but with inflation high. Okay.
When I think someone have a question on in the chat, or
Yes.
someone's raising their hand up. Yeah.
Was their hand raised?
Okay. Yes. So Reed, yes, we can let him in. Just a few more minutes here, guys. All right, let's just quickly wrap it up in a few more minutes here so that we walk into the guest speaker sessions. Unemployment is another key factor that you want to on the lookout. Here is a few indicator. I highlighted the big one in blue here, so which is unemployment rate and job growth. Once again, if you refer back to the news, we're talking about the non-farm payrolls. That is job growth. Keep in mind the non-farm payroll is only show the momentum of job creations. It doesn't show the actual job loss, right? All right, but for now, for the sake of time, Let me skip that one. Actually, all right, let's just moving on to the part that say fiscal and monetary policy. So for today, with Jesse Thompson's, we are touching on the monetary policy, which is the central bank. So there's two ways that that the U.S. can help the economy. One is from the government side, which is you go to Congress. That's how Congress passing bills to help with infrastructure and cut taxes. But then the different ways to help the economy is through monetary policies. You help using these tools to affecting the interest rate. And what are those tools means? The first tool is called open market operations. To that is basically buying treasury, buying bonds from the markets. To keep it this simple, when the government buying bonds, they releasing more money to
I
you.
think you're saying about like when the Fed buys government bonds,
Mhm.
that basically injects more cash into the banking system, which increases money supply.
Yes, and that's make interest rate going down, right?
Yeah, just to help stimulate economic growth.
Okay. And then the next tool
Mhm.
is the reserve requirements. Basically means the banks, there's always a requirement on how much banks can withhold the monies. And let's say the requirement is less, then which means they have more monies to lend out, and that would makes the economies have more monies. So the interest rate would going down. Um, well, kind of a lot of high level here, so it's kind of confusing. But the goal is with these way, it's affect the interest rate to going up or down. Uh, all right. And then just a quick exercise here. Um, Here is the information that I get from the Fed. Let's say for the unemployment, you see in 2008 when there is a housing crisis, unemployment has been going up, right? And what does the Fed do? Right here, this is the interest rate, the federal fund effective rate. It's equivalent to, well, just put it simple as interest rate. You see in 2008, the Fed cut rates because the lower the interest rate, it's easier for firms to borrow money to do business. And when they're easier to do business, they can hiring more people, right? When things get cheaper to borrow, then they could hiring more people. Um, Also for let's say for 2000, and you see the same thing for 2020 when unemployment going up all the way up here. Then you see the Fed into 2020, they also cut rates to kind of make unemployment, improve into after 2020. One thing to note is for inflation. You see after 2020, you know that inflation has been hiking up, and that is why after a few months and 1 year and a few months, the Fed have to increase interest rate to fight inflation as inflation has been increasing. So, well, that's just a few exercise to kind of analyze. I'm gonna skip the U curve as we are over time here. Let's move. So Toby, it's now time to go over the next
Yeah,
session.
thank you, Lynn. So now for this session, we're gonna have a guest speaker to be involved. So again, I am Toby Fan. I am one of the economics officers for the Econ Society, and I would like to formally introduce to our guest speaker, Jesse Thompson.